Regulation 30 of SEBI Law is the engine of continuous disclosure in Indian securities markets. It requires every listed entity to disclose to the stock exchange any event or information that is material a euro, meaning it is likely to affect the price of the securities. This is not a periodic obligation. It is a continuous real-time duty that runs 365 days a year. What makes an event material under Regulation 30? The test is forward-looking and investor-centric. An event is material if it is likely to materially affect the price of the listed securities. It is also material if a reasonable investor would consider it important in making an investment decision. The materiality policy of the company must define this, but the ultimate test is the reasonable investor standard. Schedule 3 of LODR is the taxonomy of material events. Part A lists events that are deemed material without any threshold or materiality filter. These include commencement of insolvency proceedings, fraud by the company or its key managerial personnel, a change in the directors or key managerial personnel, a revision in credit rating, and any regulatory action taken against the company. Part B of Schedule 3 lists events where the materiality test applies. The company must assess whether these events trigger the materiality threshold before disclosure. These include major litigation, labor disputes, an acquisition beyond a certain value, a disruption of operations due to a natural calamity, and any other event that the board considers material under its materiality policy. The timeline for disclosure is brutally tight. Under Regulation 30, the disclosure must be made as soon as reasonably possible and in any case not later than 24 hours from the occurrence of the event. The 24-hour clock starts when the event occurs or when the company becomes aware of it, whichever is earlier. This is a continuous disclosure regime. Regulation 30 also addresses the disclosure of outcomes of board meetings. When the board approves the financial results, declares a dividend, approves a buyback, or decides on a fundraising, the outcome must be disclosed within 30 minutes of the conclusion of the board meeting. The exchange must know what the board decided before the market opens the next day. The disclosure must be made to the stock exchange through the exchange's online filing system. It must also be posted on the company's website within 2 working days. The disclosure must be clear, factual, and complete euros, not selective, not partial, and not misleading. A disclosure that omits material information is as bad as no disclosure at all. A critical feature of Regulation 30 is the obligation to disclose an event even if it originates from a subsidiary. If a material subsidiary experiences a fraud, a regulatory action, or an insolvency trigger, the listed entity must disclose it within 24 hours of becoming aware. The listed entity cannot use the subsidiary as a corporate veil to delay or avoid disclosure. Regulation 30 requires the listed entity to have a policy for determining materiality of events. This policy, approved by the board, must define what is material, who is authorized to determine materiality, and who is authorized to make the disclosure to the stock exchange. The authorized persons euro, typically the compliance officer, the CFO, and the CEO euro, are known as key managerial personnel for disclosure purposes. What happens when disclosure is delayed or omitted? SEBI treats it as a serious violation. The penalty for non-compliance with Regulation 30 can include monetary fines of up to 1 crore per violation, trading restrictions, debarment of directors, and in severe cases, even delisting. The message from SEBI is unambiguous. Disclose or face the consequences. Regulation 30 also covers disclosure of any information that is likely to affect the company's financial position or reputation. This includes the loss of a major customer, the termination of a significant contract, the imposition of a tax demand, or a cybersecurity incident. If a reasonable investor would want to know, the company must tell the exchange euro without waiting to be asked. The listed entity must maintain a record of all events disclosed. This record, preserved for a minimum of 8 years, must include the date of the event, the date of disclosure, the content of the disclosure, and the evidence that the disclosure was made within the prescribed timeline. In a SEBI investigation, this record is the company's first line of defense. Practical compliance with Regulation 30 requires an event-triggered disclosure system. This means every key function in the company, Euro finance, legal operations, HR, ITR, must have a designated escalation officer who can recognize a material event and escalate it to the compliance officer within hours, not days. The compliance officer then makes the call. Is this material? Does it need disclosure? And how quickly must we file? The board must review the compliance with Regulation 30 at least once every quarter. The compliance officer must present to the board a statement of all material events disclosed during the quarter, any events that were evaluated and not disclosed, and any delays in disclosure along with the reasons. This board-level oversight ensures that disclosures is not just a compliance department function, but a board-governed obligation. Regulation 30 is not merely a compliance rule or euro. It is the cornerstone of market integrity. When a listed entity discloses material events promptly, completely, and accurately, it ensures that all investors, a euro, big and small a euro, have access to the same information at the same time. This is what makes a market fair, efficient, and worthy of trust. Every disclosure is a building block of that trust.